Okay, class, good evening. I welcome you to another session on strategic business reporting. And tonight, our target is to solve questions on disposal of subsidiaries. If you remember on Saturday, we finished our business combination achieved in stages. And the basic things we looked at there were the core principles around where an investor acquires controlling interest in stages. That was the major accounting issue there, where they acquired controlling interest in stages. So I really clarify that the principles we learn underneath here doesn't apply to where you acquire simple investment in stages. Like you have 20% before, you then acquire additional 10% to make it 30%, or you have 30% before you acquire an additional 15 to make it 45. That does not, accounting for that is just simply increasing the cost of investment because you're basically not consolidating. So here we are looking at a scenario whereby you had an investment before, you then acquired further investment and that gave you control. Or you had control before, but you increased your controlling interest. So basically, those two were the focus. And really, that was where my notes started from. So, and I said that when that happens, where you achieved control through piecemeal acquisition, the first is to recognize the previously held investments, which will give rise to a profit or loss on the recognition. And now that you have control, then you have to compute goodwill. Then by the way it's computed is quite different from the way you know it before because of the introduction of the fair value of previously held investment. And we solved the question to address that. And also, if it's an increase in controlling interests, in that situation, there will just be an adjustment to parent equity by comparing the money you sent with the decrease in NCI. And we solved two questions to take care of, three to take care of that. I also started disposal of equity interest with you. And for disposal of equity interest, I itemized the key items to look at. And the first is where we have subsidiary to subsidiary investment in the sense that you sold some of your holding and but you still retain control. Like you had 90% before, then you sold 20% out of that. We still have a subsidiary investment because your holding is still going to remain 70%. Or you have uh, the disposal resulted into an associate investment where you had 90% holding before, then you disposed 50%. That made you lose control. So your 40% now is an associate investment or a subsidiary investment to financial assets where you had 90% holding before, then you disposed 80%. So all this we'll look at the accounting tonight. And I said that for subsidiary to subsidiary investments, I said that is just like transaction between owners. And all we need to do is just to adjust for parent equity by comparing the fair value of consideration received with the increase in NCI, knowing fully well that you will have received money for selling that investment, and apparently you would have received that money from NCI. So NCI holding will have increased. So compare the increase in NCI with the money you received. That gives us a sense of whether we are making a profit or a loss. Additionally, where you have a situation where you lose control, okay, when there's a loss of control, you will then need to calculate the group profit on disposal, meaning profit on disposal that will be shown in the consolidated financial statement and also in the separate account. Even subsidiary to subsidiary investment, you can also recognize profits in your separate account, but I mean the focus is on consolidated anyways. But yeah, so in a consolidated financial statement, the group profit or loss on disposal, and this is done where you have lost control, where your subsidiary investment becomes either an associate investment or it becomes just a simple investment or a financial asset. And all we are doing here is that we're going to get the money we received from selling and add it to the fair value of the investment that is remaining. Okay, so whatever it is, this is like the fair value of our investment, both the one we have sold, which of course we have received money from, and the one we still retain. Then we compare it with the worth of the subsidiary by looking at what was the net asset of that subsidiary at the day control was lost. Then goodwill, since we have lost control, so we will have factored in the goodwill we paid for when we acquired that subsidiary. Would have also collected money. We will have like indirectly added the money to whoever it is we are selling to now. So goodwill now we are now selling is going away as well. Yeah. So this NCI that we are deducting here is just to ensure that we are comparing the same percentage here with this, in the sense that if our entire holding is 80%, this and this is 100% of the subsidiary. So by the time we take away NCI, yeah, it brings it down to 80%. So we'll be comparing the same with the same. Then we can then peacefully calculate our profit or loss on disposal peacefully. But in the separate account of the parent, he will also recognize profit or loss on disposal, knowing fully well that he has collected money, which is exactly the same as you will have used here as well. However, what you'll be comparing it here is just the cost of investment or carrying value of that investment. Because in the separate account, it only recognizes the cost of the investments in his books and it doesn't change really. So by the time you do that comparison, you would get profit or loss on disposal in the separate account. Okay, let's use questions to demonstrate all of this, which is the major target for today. All right. So okay. The guy that reads is not here, so I mean I've been reading. So we have Kako. It said acquired all the voting share capital of Riceco since the incorporation of Riceco on 1st January 2015 for 80,000. The statement of financial position of Kako and Riceco at 31st December 2017 as follows. Not so that is a good policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries identifiable net asset. On 31st December 2017, Kako sold 30% of his holding in Riceco for 140,000. Now we are required to prepare separate and consolidated statement of financial position of Kako at 31st December 2017. Okay, so now if you look at this question, it's clear there that we had 100% holding in Riceco. We have had that since incorporation on 4th January 2015. We only got it then for 80K, which we put in our books here. Now, this is 2017. They gave us accounts of the 200 days for 2017. We're now told that it's a good policy to value NCI proportionate share or fair value of the subsidiary identifiable net asset. We're now told that on 31st December 2017, Paco sold 30% of its holding in Riceco. So, see, the thing is this. From here now, one thing I need to clarify first is are we still retaining control or have we lost control? That's the first question that knocks on my mind whenever there is a disposal, because that ultimately determines the route in which I want to take. Because if we are still retaining control, that means all I need to do is just adjustment to parent equity and also maybe profit or loss on disposal now that I'm preparing a separate account. But if I had lost control, then I would go beyond and further to calculate good profit on disposal and some other items that will be impacted as well. Okay. Now, with that information, then I can quickly identify here in my workings one that the that that PACO still retains controlling interests in Risco. Is holding is holding or it's holding is holding in Risco fell from 100% to 70% as a result of the disposal of 30% equity interest. Okay, now having determined that, I know that it still retains control. So the first adjustment I need to make is adjustments to parent equity. And how do I determine adjustment to parent equity? I will determine my fair value of consideration received. And how much is the fair value of consideration received? You received 140,000. I will compare that with the increase in NCI. Now, I understand fully well that NCI was actually nil. So NCI is coming newly. So increase in NCI will be 30% times. So the only way I can get my NCI, okay, the value of the NCI in, of course, in Rice Co, is for me to look at what's the net asset of Rice Co at this level. I just need to look at what's the net asset of Rice Co. And the net asset of Rice Co is 80 plus 120. And I'm getting the net asset of Rice Co at the date of disposal. That is when I need to know the value of NCI. So, which is 31st of December. And that's the share capital of Rice Co plus retained earnings of Rice Co. So, to get the increase in NCI, I will do the share capital of Rice Co, which is 80, and the retained earnings, which is 120. So ultimately, this brings me to 200. So if I do 30% of 200, that will be giving me around 60. And if I compare these two, 140 minus 60, that will be 80. Now, I received 140 for giving up 60. That's a huge profit. That's a huge profit on disposal. That's a huge profit on disposal. So this will be, of course, consolidated. Additionally, is that In the separate accounts, this will go to the group. This will be consolidated. To go to consolidated retained earnings easily. However, in the separate accounts of CAPCO, you would also recognize a profit or loss on disposal. And the only reason I'm doing this is because this examiner also asks for separate accounts. If not, I will not even do it because this is what goes into the consolidated retained earnings. This one does not go. So I just have to do it because they want me to do a separate account as well. So to fulfill the examiner's requests, I'll do fair value of consideration received, which is 140. I'll compare that with the carrying amount of the investments. Now, in my separate account, I had bought the investment at 80. Now, I have sold 30% of it. The cost of that is 30% of 80. And that would give me 124. You see, the thing is this, Let me show you your area of challenge when you are revising. Let me quickly tell you now. Now we'll do you why. It'll take you time to understand. It's for you to be able to distinguish between this increase in NCI. Now, why are we using 200 here? Why are we using 80 here? It's clear. Here, I want to get increase in NCI. So to get the value of NCI, I quickly go and peep into the value of the subsidiary's net assets because NCI is based on the subsidiary's investments. That okay, because NCI are also owners of the subsidiary, just that they are minority owners. So, and that was why I looked at okay, at the date I sold this 30%, what was the worth of that 30% as far as from the subsidiaries books? So I go and look at the share capital and the retained earnings of the subsidiary as at that date, which is 120. And that's why I use 30% of 200 here. But yeah, it's me. I'm looking at it from my own investment. That okay, what's the profit I've made from this investment? Not from the group perspective. Not from I'm looking at it from my own books. And yes, I received 140, but that investment, I actually bought it for 80. And I'm selling just 30% of that. So the cost of that is 24. So that's why I'm using that. Now, this is also clearly a profit on disposal. And what's the difference of that? This should be 116. Then also is my consolidated retained earnings. Yes, I will do consolidated retained earnings because we still have control. So CACO, let's go. So as per the question, the retained earnings of CACO is 280. The retained earnings of RISCO is 120. That's the subsidiary. Then I would recognize my adjustments to parent equity, which I did in workings 2, to be 80. 80. Then I'll get group share in high school. So up until this is another area people will get wrong, that they will not mistakenly go and do 70% times 120. So 70% of this, not knowing that I only sold 30% in December. That means from January to December, I still had 100%. And this 120,000 is earnings from till December. So I shouldn't get 70%. I should get 100% of it. So that's 120. So if I add all this together, I should be looking at 480. So speaking of calco, separate and consolidated statement of financial position that ended 31st December 2017. So I have in my separate account, I will still have investment in rice school in my separate account. Just that out of that 80, out of this 80, I have sold 24. That's the cost of, because this is at cost. So I'll remove the cost of what I've sold. So let's assume that this is his own separate account and this is the consolidated. Okay. So what would that give us? 80 minus 24, that's 56. That's 56. That's 56. My voice is breaking. Okay, can you guys talk to me? What's happening exactly? And from we've started losing concentration. The rate at which you're always writing, can you please go over it again? Go over what again exactly? I should start from the beginning. Because of what? So in the consolidated account, how much will be here in the consolidated account? Of course, you know that in the consolidated account, when we are consolidating, you will have canceled out this investment against the share capital of the subsidiary. So it will be canceled out. It will be canceled out. And when you cancel out, you know that you're going to get goodwill. And one thing we omitted here was that we did not even look at the goodwill. And that's because at this level that you are, if you have been revising, even without working, you should see that the goodwill here is zero. Because at the date of acquisition, when I bought this 80, the net asset was just 20 because I bought it since incorporation. At that date, there was no retained earnings. So the only thing I paid for is just it. So the goodwill here is zero because 80 will cancel out 80 here. So this is not necessary. Then my current assets, Capco had 500. However, he has sold 30%, resulting in a receipt in money received of 140. So this 500 current asset will be increased by 140 because of money received. He's going to receive 140. So that gives me 640. However, in the consolidated account, we will need to then add this 850. So what is 640 plus 250? 640 plus 250,
It's
that would
90.
be 890. So let me put 640 plus 250 so that for those that don't want to watch the video and just want to use the notes, they can easily see that this 890 here is this 640 plus the subsidiary's current asset. So what's our total assets? What's 640 plus 6 plus 56?
696.
Okay. And this is 890. So I have my equity and liabilities. Ordinary share capital. So what's the share capital of the parent is 200. That is what will be in a separate account, and that's what will be in the consolidated account. I hope you still remember that, because that of the subsidiary will have been cancelled out. Then consolidated retained earnings, which we worked out as 480. So consolidated retained earnings, we worked it out at 480. No. That's the consolidated. But in the separate account, of this, so of the parents, it will be in the separate account of the parent, it will be 280 plus 116 in a separate account, because his profit on disposal in his separate account is 116. So 280 plus 116. So what's 280 plus 116? You can give me this figure.
396.
396. And this is the consolidated. Now, at the end of the year, we now had NCI, because when we sold, there was an increase in NCI. There was an increase in NCI by 60. So at the dates that we sold, do we really have NCI at that date that we sold? Even though I can see here that NCI has increased by 60. At the same time, yes, we sold at December 2016, 2017 at the end of the year. And at that date, we're having 100%. So at the end of the year, we had 100%. So NCI then came in. When we sold, they have 30% as at that date. But as far as the position statement is concerned, if you put in NCI here at 60, not even here, in the consolidated accounts at 60, it's arguable that as at the end of the year, we're having NCI. So why should we to put NCI there as at that date? So who can look at this and tell me, should we put NCI as at the end of the year, or should it not be there? Okay, so at the end of the year, let's leave our NCI here as 60 because it increased. So that date we sold, so there was NCI became activated as at the end of that year. And you see that I put it in the consolidated account. Put it in the consolidated account. Now, current liabilities in the separate account 100, in the consolidated 50. Separate account 100, consolidated 50. So that's 150. I said consolidated. In the subsidiaries books, 50. So we'll add it together, 150. So my total equity and liabilities. This is 696. How much is this?
890.
890. So now, from here now, I sold 30% as at the end of the year. I still retain control. That's the first thing that rings bell on my head, that I still retain control. So I only created NCI in this case because I was having 100% before. So the only adjustment I make is adjustment to parent equity by comparing the fair value of consideration received, which is 140, with the increase in NCI. And NCI increase is just for me to know, okay, what was the value of the subsidiary that I gave up? Okay, that's the NCI increase. So I looked at the net asset of the subsidiary and the date control is lost. So let me put it here. Net assets of Risco at the date control. No, at the date of disposal. So that's how I got this. So 200. So let me put so that you know that that's the workings of this 200. Let me put it in red for you so that you know that that's the workings when you're checking. So I just did the share capital plus the retained earnings at the date I lost control. So at the date of disposal, then 200. Then I did 30% of that. Then I know that, okay, this is what I'm giving up. And for that, I received 140. So I made a gain on disposal of 80 that will go to consolidated within it. Because the examiner asked for the separate account of CACO, so I had to do the profits CACO has made in his own books. So by comparing what he received with the costs of that investment that is sold. And the cost of the total investment in his books was 80. He's only sold 30% of it. So it's giving is the cost of the investment sold is 24. I compare that with what he received, which is 140, so profit of 116. Then I prepared my consolidated retained earnings. So this is the retained earnings of the individual entities, both the parent and the subsidiary. Then I added the adjustment to parent equity from workings 2 here. This 80. Then I also took my share of Riceco's retained earnings. And I took 100% because as at this date, I had 100% of this subsidiary from January to December. So I get 100%. NCI is just the increase in NCI that came in. It's just the spot amount. Then I prepared my accounts, both separate and consolidated. For the separates, this investment reflected the disposal. the cost of the asset disposed. This current asset reflected the money I received in the separate accounts, then of course in the consolidated as well. The retained earnings of the parent showed the profits he made on selling these investments in the separate account. And the consolidated has already adjusted for the parent equity and also his share in the subsidiaries retained earnings. That was it. That was it for that question. Any questions on this?
Yes, sir. Um, like in this group share in RISCO, that is 100% because the share sold at the end of the year. What of if it happened within the year? Should we prorate it?
I will show you that. So
Okay.
yeah. So if it's within a year, that means you would not be able to get um of this 120. Of course, you'll be able to get 100% up until when it was disposed, up until the retained earnings at the date it disposed, right? So then whatever happens after then would direct us whether you will also get a share of that. There's a question like that. Yeah, that's a very good question you have brought up. I will show you with figures and numbers. Any other question? Okay. Now let's look at this question. It says that Kako acquired all the voting share capital of Wisco since incorporation of Wisco on 1st January 2015 for 80,000. The statement of financial position of Kako and Wisco at 4th December 2017 are as follows. They give us all this. We're now told that it's the group's policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries' identifiable net assets. On 34th December 2017, Capco sold 60% of its shareholding in Riceco for 220,000. The fair value of the 40% holding retained was 100,000. Okay, interesting. So here again, Capco had 100% in Riceco since incorporation of Riceco on 4th January 2015 for 80,000. We're now told that the statement of financial position of Kako and Riceco at 34th December 2017 are as follows. So they give us statement of financial position of the two entities. We're now told that it's a group policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries' identifiable net assets. Now told us that on 31st December 2017, Capco sold 60% of its shareholding for 220, and the fair value of the 40% holding retained was 100. Okay, so in this case now, I can see that he sold 60%. That means he has lost control. That means he has lost control. And that would give me the direction of my workings, because when control is lost, I would calculate group profit on disposal. I would have to determine group profit on disposal. So Kako has lost control of the subsidiary. So its holding is now 40%. That's sold because it sold 60%. Now, we need to calculate group profits on disposal. And to calculate group profit on disposal, you will need to determine the fair value of his current, both the holding he has sold and the one he retained. So we'll do fair value of consideration received. And how much do you receive when he sold the 60%? He received 220. We would also determine fair value of investments retained, which is the remaining 40. What was the fair value? The examiner gave us
100.
100. So this gives me the fair value of his investment, both the one he has sold for 220 and the one he's retaining for 100. So the addition of these two is simply 320, right? Compare that with the net assets of RISCO at the date of disposal. And the net asset of RISCO at the date of disposal will include share capital of RISCO, which is, how much is the share capital? Which is 80, plus reserves of RISCO at the date of disposal, knowing fully well that it disposed in December, and the reserve as at the date of disposal is 120. So this gives me 120. If I sum this together, I would have 200. However, aside these two, if there is goodwill, if there is goodwill, it will also be added to this. Then we will then deduct non-controlling interest. In this case now, there was no non-controlling interest because this is already 100%. We sold 60. Now we had, so we can easily compare 100 to 100. So NCI here is irrelevant. And in this case now, we don't have goodwill. So our group profit on disposal is simply 120, which is 300 minus 200. Now, what is 3 is profits on disposal in the separate accounts of RISCO. Profit on disposal in the separate account of RISCO. And how do we determine that? It's just the fair value of consideration received, which is 220. We compare that with carrying amount of the investments at the date of disposal, which is 30% times, because I sold how many percent? Oh, we sold 60%. You sold 60% of 80, which is the cost of the investment. So that's 48. So what's 220 minus 48?
172.
Sorry?
172.
172. So we have 172. Then we have our consolidated retained earnings of CACO and RISCO. So as per the question, This 280 and
Yeah.
this 120. 280, 120. We'll have group profit on disposal, which is also 120. Group profit on disposal, 120. And I will get my group share of Risco. And since I didn't sell until December, I'm still going to get 100% of Risco, which is 120. So if I sum this together, this should graciously give me how much? Is this 520?
520.
5 what?
20, sir.
520. Okay. Okay. So, and that is all for this. So I have to prepare separate consolidated statement of financial position as that year ended 31st December 2017. So investment in Risco, I had 80. Now I have sold
48.
cost 48. What was the difference?
32.
32. So let's assume this is okay, let's do like this. Let's say this Kako and this consolidated. So in the consolidated, the investment retained would be like an associate investment because we still have 40%. And don't forget, we consolidate that. So this is 100. Secondly, the issue of goodwill will now arise since we have lost control. So we have current assets. So this is 500 plus how much did we receive? 220. So 500 plus 220. This 720. In the now we cannot consolidate because we have even lost control. So we cannot add these two together because we only have 40% left. So that means how much will be here? Still the 720. So what is my total assets? This will be 752 and this will be 820. Equities and liabilities. I have my share capital. What is the share capital? This 200. This will also be 200. And that is also what will be in the consolidated. The consolidated retained earnings. In the separate account of the parents, we'll have 280 plus 172. Profit or loss on disposal in a separate account. So 280 plus 172, what would that give us?
$452.
Again, 452. Okay. Then the consolidated, what do you have here? 520. 520. Then my current liabilities, parent 100, subsidiary 50. We can consolidate to 100 for the two. So current liabilities 100, 100. Total equity and liabilities. How much is this?
752.
752. How much is this?
820.
820. So this is similar to what we have done before, except that now we have lost control. When we lose control, we compute group profit on disposal. And to get it, we'll look at, okay, how much did you receive? How much is remaining? All at fair value. We then compare it to the net asset of the subsidiary at the date we lost control, which was this. If you had goodwill, we will have lost that too. Then we'll remove NCI just to bring the two at the same basis. We'll look at questions like that. And in the separate account, we'll also determine profit or loss on disposal by comparing the money we received with the cost of that investment, meaning proportionately to what we sold. Then if we are still going to have a share of the subsidiaries retained earnings, we have to do this schedule to get the consolidated retained earnings. Then that gives us this in this case, not forgetting to put group profit on disposal. And we went ahead to prepare both separate and consolidated financial statements. Any questions? Now, another question. We have Resco. This class is too, is it that everybody is so tired? I have Michael's in class that used to ask questions. I have Shine here in class. I have Ufoma in class. Even though she has been distracted recently, she's always saying, start from the beginning again. But nobody is asking any questions. Let me assume that you guys are tired tonight. It's okay. So, it's talking about Resco. It says that Resco acquired 80% of the share capital of Maxco for 162,000 on 1st January 2015. At that date, Maxco's retained earnings stood at 90,000. The statement of financial position at 30 September 2017 and statement of profit or loss to that date are given below. So they give us all this. Okay. We're now told that it's the group's policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries identifiable net asset. Ignore taxation required. Prepare consolidated statements of financial position, a statement of profit or loss at 30 September 2017 in each of the following circumstances. A. Resco sells its entire holding in Max Co. for 325,000 on 31st September 2017. B. Resco sells 25% of its holding in Maxco for 80,000 on 30th June 2017. This was the one Mr. Hussaini was asking the other time. So, as I said, it was a good question. So, Resco sells 50% of its holding in Maxco for 70,000 on 30th June 2017, and the remaining holding has a fair value of 125 and should be treated as an associate. Resco sells 50% of its holding in Maxco for 170,000 on 30th June 2017. And the remaining holding has a fair value of 125,000 and it should be treated as an investment in equity instrument. This last one is similar to the first one. Where did I put it? So let's solve this. Let's start with A. Okay. So now, Resco had 80%. He bought it for 162,000 on 1st January 2015. And at that date, he had a retained earnings that stood at 90,000. So this is a pre-acquisition retained earnings. And I was given statement of financial position, statement of profit or loss with a year end of 30 September. So now, so now is the group's policy to value NCI at proportionate share of the fair value of subsidiaries identifiable as net asset, hidden taxation. Okay. So Resco sells its entire holding in Masco for 325,000 on 31st December 2017. Now, here it's clear that Resco has lost control of Masco. Its holding is now 0% as at the end. 2017 is now 0%. And immediately I know that we have lost control. Do you know what comes to mind? Group profit on disposal. But now, before I rush into computing group profit on disposal, I know that I will need goodwill because I'm also going to be losing goodwill. So I don't want to get to goodwill and start looking for goodwill around. So let me compute my goodwill. Now, the level of rounding is in thousands. So let me do my goodwill, do my consideration transferred. When I acquired the 80%, acquired it for 162,000. So 162. Then non-controlling interest, they value it at proportionate share. So I will need to get net asset acquired. So I can, and this net asset acquired is at the date of that acquisition. And at that date, the ordinary share capital of the subsidiary is 90. And the pre-acquisition retained earnings is, how much is that? 90. When I acquired this 80%, retained earnings stood at 90. So 90. Now, it's all that information. The net asset acquired is 180. So I can get my NCI now, which is 20%. Remember that I had 80% when I acquired newly, times 180. I guess this should be 36. This should be 36. So if I sum this together,
198.
198. Then what's my goodwill?
18.
Okay. Now I have sorted goodwill. Then I can move to group profit on disposal now. I will get, okay, how much did I receive when I sold my entire holding? That's my fair value of consideration received. How much did you say I received? 325. Yeah, I didn't retain any investments. I didn't retain it because I actually sold everything. So I'm looking purely at a total of 325. I'll compare that with the net assets acquired at the date of disposal. And like I've done before, this will comprise the share capital of that subsidiary here, which I already did here, of 90. That's one. Two is retained earnings of the subsidiary at the date of disposal. And knowing fully well that I disposed at the end of the year, that means I can easily get the retained earnings of the subsidiary on the face of the statement of financial position as 180. So this is 180. That means that the net asset acquired here is actually 270. Then, if there is any goodwill, in this case there is, I will then add it to whatever I have, which from workings 2 is 18. Now, remember, this 325 represents disposal of 80% holding. This net asset acquired is the total value of the subsidiary at the date of disposal, including the goodwill that I owned before, but now I have to give it up because I've sold controlling interests. So it's not possible to then compare this against 80%. So in order to bring this down to 80%, I will have to deduct non-controlling interest. Now, how do I get my non-controlling interests? Now, I can say this, I can say this, that This one will always give you challenge when you are revising. Yes, I'm saying it because you would always think that maybe there is NCI here. We got 36, and there's another NCI here. Why are we not getting different figures? Because you always get different figures now. Because goodwill here, we're looking at the NCI at the date of acquisition. NCI, the value of the NCI as at January 2015. Here, we're looking at the value of the NCI at disposal, at the date of disposal. So they are not the same. The NCI value will have gone up now. So, and it's usually 20% because NCI as of September, I mean, was 20% before we disposed. And it's 20% on the net asset acquired at the date of disposal. You always get that 1 year because you have computed it when getting this first. So of 270. So if you do 20% of 270 to definitely give you 54, you remove it. So removing it now, now brings everything it brings these net assets down to 80%. Brings it to 80%. Because now we are removing 20% from 100%. So what are we looking at?
234.
270.
230. 234.
234. Okay, 234. Now, what's 234 minus 325?
91.
1.
Now, this is a profit. It's a profit on disposal. Because what I received, my value right now is more than what I'm giving up. Is more than the value of the carrying amount of my investments. So it's a profit. Now, I don't need to calculate that profit or loss in the separate account of the parent because I don't need it. The examiner didn't require for me to prepare the separate account of the parent. So I ignore that. Then I can go straight to my consolidated retained earnings, which is the retained earnings of CAPCO plus my share in the retained earnings of RISCO. The level of rounding off here is in thousands. Therefore, I would ask myself, what is the retained earnings of the parent and the subsidiary at the dates of consolidation? It's
207.
207 and 180. Then, since I need to get just my share in the post-acquisition retained earnings of RISCO, I would ask again, was there any pre-acquisition retained earnings when I
Yes.
acquired this guy? Yes, there was. I'll have to remove that.
90.
That means I am left with a post-acquisition retained earnings of
Of
90.
90.
However, are there any items that should be added to the retained earnings of the parents? Again, yes. We have group profits on disposal of 91. This is working straight. I have 91. And I will get my group share of RISCO at the date of disposal. At the date of disposal, before I disposed all in September, I had 80% up until that date. I will get a share of 80% of this 90. And 80% of 90 clearly gives me 72. If I had 207 plus 91 plus 72, what would that grant me?
370.
370. And that's my consolidated retained earnings. So, CACO, consolidated statement of financial position, as at ended 31st September 2017. So let's consolidate. Now, the first item here is PP. Can somebody add this for me? What is 180 plus 135?
315.
315.
So we won't consolidate because we've lost control.
Thank you very much, my smart girl. That's absolutely correct. We won't consolidate because we have lost control. So we're only going to add that of the parent.
Parents.
We're only going to add that of the parent. Now, investments in Masco. This has cancelled out. And as a result of that, we had a goodwill of 18. So we'll have goodwill from, I think, what is true, of 18. Then we have current assets. Again, cannot cancel out. But this 185 is no longer 185 because when we sold, we received 325. So this should be 185 plus the money we received when we sold. So how much is that?
$510.
You said 510, Abi?
Yeah.
Yes, sir.
Okay. So what's my total assets?
708.
708. Then my equity and liabilities, starting with equity, what's the ordinary share capital of the parent? How much is it? 270. 270. Then we'll get consolidated retained earnings from, I guess, I think what was 4. So, yeah, we have 370. Now I'm back again. Are we going to have non-controlling interest at the reporting date? No, we can't, because as at the reporting date, there was no NCI. We had sold. As the position at that date is that we had sold all our holding. So we are not in position to incorporate NCI anymore. In fact, we don't even have anything in this company anymore. So this becomes 370. Now, what again?
Liabilities.
Our current liabilities. What's our current liabilities?
50.
50. So what's the total?
This is 690, sir. 690.
690. Why are we not having the same figure as above?
So is it the goodwill?
Oh yeah, it is. We have lost control. So we should not put goodwill.
690.
690.
Yeah. So we should not even incorporate the goodwill because we have actually lost control. And that's why we're having that difference. Okay. So for this one, when we lost control, the first thing we did was to calculate goodwill because I know that we're going to need it here. And we computed it, we had 18. Then we computed the group profit on disposal also by looking at what we received, what we returned, 325. Then we got our net asset acquired at the date of disposal by looking at the 90 and the retained earnings of the subsidiary at the date of disposal. Then we added goodwill, but this adding goodwill yes, it means we have sold it, so we can't incorporate it again in our books. Then non-controlling interests, just 20%, just to bring this down also to 80%. So that we are comparing 80% with 80%. So we had good profit on disposal that we added in our consolidated retained earnings, and we our share in rice score as well. Because as at September, we're still having 80%. So we would share profit up until September. And that gave us this. Then we consolidated. And in consolidating, since we have lost control, we could not incorporate the statement of the subsidiary. This 325 here was the money we received when we sold our holding. And in fact, we made a mistake before we added goodwill, and we could see that the account imbalance because of that 18. So then we have ordinary share capital, consolidated retained earnings, and the liabilities. Now, the second one is CAPCO, consolidated statement of profits or loss for the year ended 31st September 2017. So, yeah, we have PBT. So this one, we are still going to consolidate. We will actually still consolidate P&L because we only lost control at the end of the year. So we're still going to get, we will consolidate all through the year because we were there all through the year. So can somebody add this for me? 76.5 plus 63.
139.5.
139.5. So our income tax expense, what's the addition of these two?
40.5.
40.5.
40.5. So what's the group profits for the year?
99.
Now, we're now going to do profits attributable to owners of parents and non-controlling interests. Now, we'll do non-controlling interest first. That was 20% till the end of the year. It can't be of this. This is group profits. NCI can only share profit of the subsidiary. So we'll go to the profit of the subsidiary. It's 45. So it will get 20%, 45, which is 9. Parents will get the balancing figure, which is 90. So it balance out as 99. That's the end of this question. Now, scenario 2. Resco sells just 25% of his holding in Masco for 80,000 on 30th June 2017. So, B. Now, for this, Resco retains control of Masco. So its holding is now how many percent?
55.
It's now 55% as at when? As at 30th June 2000. And I know that the way we got this 55 is 80% minus what?
25.
Minus 25%. Now that we retain control, do you know what we do? We'll do adjustment to parents what? To parents equity. So this one, we are not losing control. So we don't have to stress so much with this. I'm still going to consolidate it, just transaction between owners. So I will compare consideration received for the sale, which is 80. I'll compare it with now NCI has increased. Increase in NCI. And since NCI is measured at proportionate share, I know that NCI has increased by 25%. So what is the increase in this NCI? And I'm getting this NCI increase as at June is at the date of disposal. Now, since NCI is measured at proportionate share, so the workings for that is I will need to get the net assets of Risco at the date of disposal. So I can get 25% of that. What's the share capital of Rashco? Should be 90. What's the retained earnings of Rashco at 30th June 2017? What's the retained earnings of Rashco as at 30th June 2017? So the only way to get that is this, because there is no way it is given. I know the retained earnings of Rashco as at September, which is 180. 180. And I know that inside this 180, there is this profit for the year of 45. Now, if I can actually take out the profit for the year from July to September from this 45, if I can take that out from this 180, then that means I will be left with the retained earnings as at June 2017. Again, I need the retained earnings of the subsidiary as at June, just so that I can get the net asset acquired as at June. The only way to do that is, when you take retained earnings, is retained earnings from the beginning. So I looked at my similar financial position. I know I have retained earnings as at September, because this is the year end. So, and I know that what I need is retained earnings as at June. So I just need to get, okay, what's the profit for the year? I take away profits. That is July, September. From this 180, I would be left with the retained earnings as at June. And that's the approach I'm going to use. So I would do 180 minus 3/12 times 45. What would that give me?
168.75.
Okay, if I sum these two together, what would that give me?
$258.75.
Now, I can do 25% times 258.75. What would that give me?
$64.69.
64.
0.69.
Okay, let's just approximate.
64.7.
Yeah. So what do we have here?
$144.7.
You are comparing the two.
Okay, sorry. 16.7.
It's not possible now.
15.3.
15.3, sorry.
Is this a profit or a loss?
It's profit.
Profit.
It's profit on disposal. It's profit on disposal because I received 80. This is what I'm giving up to NCI. I'm giving up 64.7, so it's a profit. Now, that's it. But since I'm going to be consolidating, I'll still need to determine goodwill. I'll still need to determine goodwill. And I don't need to compute it again because it's the same thing as what I have here.
Yeah.
I'll just copy and paste here. So I get my goodwill. When I acquired in 2015, it was 162. NCI was 20%. Then net asset acquired. I shall have 18 as my goodwill. So, and finally is the consolidated retained earnings of CAPCO. Rice Group. As per question, it should be 27 and 180. Deduct so this gives me 90. Now, if I do it like this, I'll be faced with a lot of problems because let me put my adjustment to parent equity. Let me put it here. How much did I get that time? I got 15.3 from workings 2. 15.3. Now, let me now take my group share. Now, the question is, my group share, how much do I have at the end of the year?
Sorry, sir, I have a question.
Oh, yeah, ask.
As per question, the 180, since you're consolidating at June, won't you take the...
No, I'm not consolidating at June. I'm consolidating at September.
Okay.
I'm consolidating at September. But even at that, we are still going to be faced with problem because as at September, what's my holding? My holding is now 55% of this guy. And I cannot take 55% of 90 because this 90 is the post-acquisition retained earnings from 2015. From 2015. Yeah. From 2000. So, and this with 5% only came up in June, which is what I think my friend is trying to talk about. So this with 5% holding only came up at the end of June. It should only get his share of profits from July to September. This with 5%. Meaning that from that June, I should be able to get from the beginning of my investment up until June, I had 80%. So how can I do that split? The best way is this. You will do that split here. We'll do, okay, when we add 80%. And also, it's not content. We'll do it like this. Let's go at 80%. And let's go at 55%. That's the only way. Because just doing one will not work. And when rice school was at 80%, it was at 80% till June. After June, it was not 80% anymore. And as at June, thank God, thankfully, we had already worked out retained earnings of rice school as at June. This is the retained earnings, 168.75. So his retained earnings as at June is 168.75. Rice school, our investment in rice school was 55%. So this, as at December, that was when we had 180. So when we acquired this 80%, the pre-acquisition reserve or retained earnings was 90. That's fine. But when we acquired 55%, who can tell me what was our pre-acquisition retained earnings? When we acquired, in fact, not when we acquired, when our holding,
168.75.
that's my girl. You're very intelligent. 168.75. Yes. Because our holding became 55% in June, and we already said that as our June retained earnings was this, which we computed up here together. So that will represent the pre for this guy. So what's the difference? Between this and this two?
$78.75 for 80%.
78.75. How about this?
11.25.
11.25. Yeah. So now it's now very clear that as when we had 80%, we had 80% up to June. And the post-acquisition retained earnings up until June is 78.75. So we can get 80% of 78.75. When our holding reduced to 55%, it was from 30th of June up until September, just 3 months. Our holding is the post retained earnings at that down is 11.25. So can you give me the figures here?
63.
This 63.
At 80%.
Okay, how about there?
6.19.
Sorry?
6.9.
6.9.
Yeah, let's just do 6.2. So let's sum this together. 207 plus 15.3 plus 63 and all that.
291.5.
291.5. Now, I've gotten my consolidated retained earnings. So since I still have control, then let's determine non-controlling interests. Let's determine non-controlling interests. So what's the value of NCI at acquisition? At the time we acquired NCI, at the time we acquired our holding, was 36. Okay, 36. Then we sold some holding to NCI, resulting in an increase in NCI. So there was an increase in NCI by 64.7. So increase in NCI 64.7. So NCI share of Rice Co earnings. You will also have when he had 20%. So you would take 20% of 78.75. And when he had 45%, when he acquired additional 25%. So that's 11.25 of this. So can you give me the figures?
15.75 for 20%.
15.75. How about this?
5.1. 5.1.
Okay, let's just say 5.
Okay.
Yeah, so let's sum it together.
122.
What?
121.5. Yeah,
That's
122. 120. I approximately 120.
Okay, let's just leave it at 122. So CACO, consolidated statement of financial position as at year ended 31st September 2017. So what's the first item here? TP. So what's the addition of these two?
315.
315. Then goodwill. So that is 18. Then current assets. to be, let me add these two together.
370.
370. But don't forget to add the consideration received plus 80 is what?
450.
450.
450. Okay, so let's add this together.
783.
Okay. So what's the ordinary share capital of the parents? It was 270. What's the consolidated retained earnings from workings for 291.5? So then more controlling interest more plus 5 and 22. Then current liabilities. Let's current liabilities. This is 100. So what would this give us?
783.5.
Okay. Maybe we should have left this as 121.5.
Yes.
So it's now just balanced out. Now, profits before tax will consolidate fully. So what's the addition of these two?
So are we going to prorate it?
Why do you think we should prorate?
Since they sold some in between the year.
We still had control, so we will still consolidate fully.
Okay.
139.5.
139.5. Income tax expense. What is the addition of these two?
40.5.
So what's the difference?
99.
99.
Profits attributable to first. So owners of parents, they were 20%. You already know that I can't do 20% of this. So it will be of the profit for the year of the subsidiary, which is 45. But even at that, you know, it was only, as far as this year is concerned, it was 20% for 9 months. The remaining 3 months, he has acquired additional 25% for the remaining 3 months. So, and that's how this will fly. So how much is this?
6.75.
6.75.
How much is the second one?
5.07.
15.1.
What's happening?
Just 5.01, just 5%.
5.07. 5.07.
Okay, so what's the addition of the two?
11.75.
11.82. 11.82, sir.
I can feel it, man. So let's leave it at this. So owners of parents. So what's 99 minus 11.75?
87.25.
Okay. So last time, 10:30, 2 hours. I'll stop here for tonight. So take your time, revise, solve it yourself. I'll have asked you to attempt C and D yourself. I will still ask you anyways, so go and attempt it yourself. On Saturday, we're going to solve this remaining two, and we're going to start we'll start foreign subsidiary on Saturday. On Sunday, I'm going to start cash flows, but I won't just jump into consolidated cash flows. I will start with simple cash flows with you. Then the consolidated is actually very straightforward. It's just few things that we need to add. And that will be the end of group accounts. So the next thing will be ratio analysis. Ratio analysis, then EPS, then that will be the end of this class anyways. So I'll see you guys on Saturday. Just keep reading, keep studying. So I will tell you the plans later because we'll likely be having a revision class, a 2 days revision class, intensive class, not just for you, but for a lot of students that want to join at the same time. Like that, to be 2 days to solve pilot questions, to revise those key standards and all of that. I mean, to be a marathon class like that, to revise everything. I mean, let's finish the syllabus first. And the intensive class is not really targeted for you because as far as we are concerned, we have delivered our responsibility to you by teaching you every aspect of the syllabus and solving past questions for you. So that's our primary objective this month. So let's achieve that. Then anything else will come up in November. That's even if you're interested. You might not even be interested in joining that. Bye for now. I'll see you in the next class. Bye.
Sir, yes, sir.
Thank you, sir.
Sir,
Yeah.
the revision class will it be online also?
Oh, yes, to be online.
Okay, sir. Can you share this video as soon as possible, sir? You know, I didn't start the class with 2 people, sir.
Oh, okay, no problem. I'll do that.
All right, thank you, sir.
You're welcome. Good night.